Hi, this is Rajat Bose here. We are coming up with our 23rd edition of weekly stock recommendations, market review comprising a study of Nifty, Bank Nifty, cnxmidcap, as well as there will be 3 stock reviews and a couple of stock recommendations. We are now going to start our Nifty studies. This time the Nifty studies would be done using weekly chart as well as the daily chart. Nifty has been trying to stage a comeback, has been trying to stage a rearguard action, but any recovery attempt from lower levels, unless it takes out the critical supply zone between 19,700 and 19,800, you cannot trust any rally as such, because unless it takes out the 20-day exponential moving average, there will be fresh selling and it can go further down. The chart that you see on the screen, daily chart of Nifty, it shows that after the hammer line that was there at the bottom on Wednesday, when it touched a low of 19,333.60, from there the recovery attempt has been made. Already we have seen a 300-point run up in 3 sessions. There has been gap up openings on Thursday and Friday, and today, good thing is that up until last Thursday, there was all the moving averages were above the closing price. On Friday, when it closed at 19,653, it is actually above both the 50-day as well as the 9-day moving averages. 50-day is at 19,559 and 9-day moving average is at 19,618. So it is above these two moving averages. What it needs to take out is that the flat 20-day moving average located at 19,786. Nifty needs to take out the 100-point range, the critical range between 19,700 and 19,800. Only if it decisively takes out 19,700 to 19,800 range, there would be an upswing, or else it may actually come down. Now look at the weekly chart. The weekly chart of the Nifty shows that there is also a hammer line. This time the 20-week moving average, which is at 19,324.98, and the low was 19,333. That means it was less than 10 points to test the 20-week moving average. From there the hammer line has begun, and the hammer line opening was 19,622, that is this week's opening, last week's opening, and the close is 19,653. This gives rise to a possibility that there could be an attempt to scale up. But as I said, that unless it takes out 19,700 to 19,800 range, do not expect further uprise. But if it were to go above that, then 20,000 or 20,100 might be scaled up. But as of now, let's see if it manages to take out 19,800 and then 20,000 mark. Bank Nifty, so long as it does not cross the 45,000 mark, all rallies are expected to see fresh selling coming in. Since the rallies are orchestrated by some stocks going up in the Bank Nifty, but total Bank Nifty constituents are not participating, that is the reason why Bank Nifty may not sustain above 45,000 mark, and if it doesn't sustain about 45,000 mark, then it is likely to go down and even pierce 44,000 as well. What you see on the chart is, again, this is the Bank Nifty chart where we see a small hammer line, but this hammer line actually could not take out neither the 9-week moving average, which is at 44,707, and the 20-week moving average, which is at 44,604. So 44,604 to about 44,707, roughly 100 points. This range will be a resistance for the Bank Nifty. Unless it takes out 44,700 decisively, there will not be much of an upswing. Most of the bank stocks, the leading bank stocks, are still showing weakness. So chances are that the Bank Nifty may not really participate if the Nifty were to see any kind of an upswing. So in this weekly chart, what we see is that there is a probable support coming in 43,900 level. If it were to go down, if it were to break down, then the weekly low, last week low was 43,857. So 43,900 to about 43,850 would act as a support area, and once that gets taken out, there is this possibility that the index may come down further. In case that happens, the 43,300, and after that it would bridge the 43,000 levels. 43,000 level is a very strong support area. If that gets taken out, then there is a possibility that 42,750 could be retested. That is the daily chart, year-to-date daily chart of the Bank Nifty. We see a doji cross kind of a formation. This suggests that there is already some kind of hesitation on the bulls' part, that whether they are ready to push it further up or not. They have just tested the 9-day moving average, which as of now is at 44,456. If 44,456 is not decisively taken out, we would not see much of an upswing in the Bank Nifty. And the whole range between the three, among the three moving averages, encapsulated by the three moving averages, 9-day moving averages, 9-day moving average, and 50-day and 20-day exponential moving average. The range is 44,983 on the higher side and 44,456 on the lower side. That means a cool range of about 540 points. This 540 points would bring in a lot of supplies. In fact, whether it would cross 44,700 or not is something to really see, because this 50-day moving average was actually resisting the Bank Nifty quite a few times. Now we are going to talk about the cnxmidcap. cnxmidcap index has been correcting, but the correction is not the kind of correction you are seeing in the Nifty or Bank Nifty. The reason behind that is that retail has not given up. SIP money is still coming. Let's see how it pans out. Now we are studying the cnxmidcap. cnxmidcap, it's the 4th week of correction. There is a small hammer line here as well on the weekly chart, but it has closed again on the Gann angle. So it is trying to reclaim the Gann angle on the 4th week. So whether it manages to do that remains to be seen. If it were to cross 41,000 level, 4750 to about 41,000. If this range is taken out by the CNX midcap, then it will reclaim the GAN angle, as well as it would again embark on further upswing. So long as that does not happen, we need to see whether the level of 4500 to about 4650, that would act as a resistance zone, and if it were to get past that, then only expect 41,000 or 4750, all those levels might come. So the weekly chart actually signaling a possibility of an upsurge, but it remains to be seen whether it manages to take out 41,000 or not. If it doesn't, then again there could be fresh selling pressure coming in. Now look at the daily chart. It is the YTD chart of CNX midcap. CNX midcap, the YTD chart, the sideways movement in the daily chart is clearly visible, but the gradient is somewhat lower because it is below both the 9-day as well as the 20-day moving average. Even now, on the last close, even the close, although the close is the highest of the last 3 days, the weekly close is 4284.70, which is the highest close for the last 3 sessions, Wednesday through Friday. Now it needs to take out 4300 to about 4500. 4300 is roughly the level of 9-day exponential moving average, and 4475 is the 20-day exponential moving average. So that being the case, it needs to take out these two, only then you will see some kind of a recovery happening. So whether this recovery happens or not remains to be seen, but as of now there is still some weakness, but there is also a hope that some kind of an attempt might be made to take the index further up. If you like my presentation, please press the like button, subscribe to my channel, share it, and also don't forget to press the bell button so that you get the notifications from YouTube whenever I post a new video. Now we have come to the segment of our stock reviews. We have got lots of requests to review quite a few stocks. We have chosen 3 stocks. Whatever you have been asking for, we have done that. Apart from that, we have revisited some of our previous recommendations. Our first recommendation stock is Zen Technologies, currently ruling at 728. It is taking support on the 50-day moving average, while the 9-day and the 20-day moving average is resisting it. It is going through a correction since mid-August. The correction is still continuing, although there had been a rearguard action in the month of September, but then that rally fizzled out on the 4th day, and after that for the last 6-7 trading sessions it is still coming down. If you look at the weekly chart, you will see that Zen Technologies has had a huge run, especially in 2023 from 200 to 900. This is a huge run. My suggestion would be that you book profits. If you do not want to book fully, then at least part profits, and if it goes further down below say 650 or so, you should get out of it. 600 to 550 is a likely possibility. As you can see that 550 is the 50% retracement level of the Fibonacci that we have drawn from this year's low, or rather the April low, and the high around 900. So the 50% level is about 551. So if it were to fall below 700, it can go to those levels. So better you take care. You have had a big run. So now some money should be put off the table. Our second review stocks is IDBI. Now what you see is the daily chart. The daily chart suggests that at higher levels, especially between says 72 and 75, it is actually experiencing quite a bit of selling pressure. This is understandable that it has actually moved up quite a bit, and now there is this negative moving average crossover, which suggests that it might still come down. But the point here is this, that IDBI Bank is looking good. Even though it may come down a bit, it may test its 50-day moving average, which is around which is around the level of 65. If it were to break down below that, then you have a problem. Otherwise, you should continue to hold this stock. Now what you see is the weekly chart of IDBI. This is what I wanted you to look at. This shows that it is actually forming a saucer pattern, and it is gathering steam. So any fall is actually temporary, and you put a stop loss below 60. If this 60 level is taken out, then only you should think of booking profits or getting out of it. That is it. But otherwise, it's a good long-term bet. You can keep it. As demanded, we have taken Gokaldas Exports as our third review stock for this week. In one of the comments to one of our weekly stock recommendation videos, somebody asked for this Gokaldas Exports to be reviewed. We are doing that. This is the weekly chart of Gokaldas Exports. Even this also gives you an indication that over the last 3 years, right from the middle of 2020 to current date, you can see that Gokaldas Exports moved up in steps. Up to 2022 April or so, it moved up, and then it went through a correction, and this year around April May, when the rally began in mid-cap, it also started moving up, and it moved up from a level below 400 to current level of around 806. It moved almost up to close to 900 levels. What we suggest is that you book profits here, at least part profits, book part profits here, and put a final strict stop loss at 680. Now we have come to our cherished recommendation section. There will be two stocks. We are trying to find out what can be bought. The market is weak, yet we gotta find two new stocks. Our first stock recommendation is Tata Communications. Tata Communications has closed at 874. The recommendation is to buy with a stop loss below 859, and on the upside the targets are 899 and 909. Look at the chart. Whenever after a protracted correction lasting for a week or more, and whenever there is a strong green candle, that is a strong bullish candle, has given a good movement on the upside. This pattern has been the case for several times, at least 3 occasions in the past 3-4 months we have seen. Again, the similar kind of a pattern has been seen on Friday, when it opened at 861 after testing the low, that is the low itself. It is an opening Marubozu, and from there it went up to 877, closed at 874. This gives rise to a possibility of short-term upswing, and the short-term upswing would at least meet the same level of 909 reached on say 7-8 trading sessions back. So that is the reason why we have chosen a short-term bullish trade, short-term buy. Our second and final recommended stock is Infosys Technologies, INFI. Now what you see is the weekly chart. The weekly chart clearly shows that there is a piercing line. The candlestick pattern name is piercing line because the red candle the prior week, the current week or the last week's candle as a green candle almost fully covering the previous red candle. This is a piercing line. This is a bullish signal. And look at the moving averages on the nifty INFI, the 9-week, 20-week as well as the 50-week moving averages are changing direction towards the movement upward, towards an upward movement. Now all the three exponential moving averages are changing direction on the upside, and given that we can expect further upswing here. So here in my view, INFI is a buy, at least for the short term, where we project a target of 1545 and 1616, and the stop loss should be placed below 1425. Duration of the trade 2 to 5 weeks, and I do not have any position in this. That is a disclosure from my side. However, if it continues to move further up and goes beyond say 1625 or so, then there is a possibility that this could morph into an intermediate uptrend. Has seen a severe correction, but now it could actually see further upswing. If you like my presentation, please place the like button, subscribe to my channel, share it, and also don't forget to press the bell button so that you get the notifications from YouTube whenever I post a new video.